Well, what is going on, guys? Luke here today, and are all the predictions of hyperinflation completely true? I mean, we've printed more money quicker than ever before, and there are many smart people like Michael Burry who sees the end nearing. So let's explore all this and find out the truth and what you should do about it. And all I ask for in return is that, you just gently, or not so gently, smash or tap that like button and subscribe if you haven't already. And for a limited time only, the private group is still on sale, where I just added my complete Building Wealth with Stocks course for free. That's normally $300. And there are 2 more courses in the works right now that will also be released to the private group for free as well. So instead of dumping hundreds of dollars into a course from somebody else, why not join the private group and get a ton of other benefits in addition to the courses at a fraction of the cost? And if you don't like it, you can just cancel instead of losing hundreds of dollars instead. Alright, now let's dive into this hot topic of debate. So Michael Burry, the guy who was played by Batman in The Big Short, which is a great movie, although I think the book is even better in my opinion, of course, at least for finance nerds like me, I think it's better. But the long story short on The Big Short is he called the housing bubble in 2007, and everybody thought he was crazy until he wasn't crazy, and he made a stupid amount of money off of it. So now he recently tweeted about how hyperinflation is coming. And here's his tweet right here. The US government is inviting inflation with its MMT-tinged policies, brisk debt, GDP, M2 increases while retail sales, PMI stage V recovery. Trillions more stimulus and reopening to boost demand as employee and supply chain costs skyrocket. So he says a lot right there, and I encourage you to research the individual pieces that you do not fully understand. But to save at least 20 minutes of your time, the bottom line with that tweet and subsequent tweets referencing Germany in the 1920s and 30s is we will see hyperinflation that will ultimately end like Germany did, with a total collapse of the economy by doing what we are doing right now. And he's not the only one saying hyperinflation is coming. There are many other people who have been saying with all the money printing going on, it's inevitable we will not only have inflation, but hyperinflation, and it will tank the entire economy, stock market, and real estate market, and basically everything. So Michael Burry was right the last time he made a big prediction like this, and this time he's not the only one calling for it. I mean, we can all see money being printed like never before. And I think we can all agree we are seeing some things get a little bit more expensive at the store, and companies are citing increased costs to produce in their earnings calls. And we all know the economy is not fully reopened yet, so I think we all agree there's a lot of pent-up demand out there. So this seems to be the perfect recipe for hyperinflation coming at us fast and furious. So that's it. We're all just doomed. Let's buckle down and buy Bitcoin en masse and just wait for the collapse. Oh, but wait. Michael Burry also says Bitcoin nor gold is safe either. Here's his tweet about that. Prepare for inflation, reopening and stimulus on the way. Pre-COVID, it took $3 debt to create $1 GDP, and it's worse now. In an inflationary crisis, governments will move to squash competitors in the currency arena. And then he references, Bitcoin and hashtag gold right there. So not only will we have hyperinflation, but traditional safe havens like gold and new hedges like Bitcoin are doomed as well. So we're all just screwed. There's no need to do anything except for prepare for the apocalypse or buy an island with all this free money and live there until the new world order is established. Not so fast, people. There are actually 2 reasons why I believe we will not see hyperinflation, but instead somewhere between 2 and 4% at the max, which is what the Fed actually wants. Unlike Germany in the 1920s and 30s, the world is a very different place, and the US is in a different spot than Germany during that time frame. So I think it's going to be different this time around. And the first reason we won't see hyperinflation? We actually already saw this movie in 2008. For those of you that don't remember, this same inflation predictions took place in 2008 when the world printed what was a record level of money at the time. I mean, everybody was printing money everywhere. While it's true that money printing completely hurt other countries, here in the US we did not see the inflation everyone else was worried about at all. And here's the proof. Look at the chart right here. We actually saw inflation continue its overall decline in the coming years after all that stimulus hit. And that has been the trend despite the Fed's balance sheet ballooning over that same time frame. And that's the perfect lead into the second reason, which is asset price inflation. With the Fed's balance sheet just exploding since 2008, there had to be inflation somewhere. Well, let's look at asset prices since the money printer started in 2008. And here's real estate right here. You see the bubble popping in 2008, money starting being printed, and real estate has skyrocketed over 56% the following 12 years. And remember, during that time, inflation has come down. And let's look at the stock market over that same time frame. Again, since the crash in 2008, the S&P 500 has skyrocketed over 400%, which is just mind-boggling. That means it's averaged over 15% return each year on average, while inflation has moved down on average each year despite printing records amount of money. So what does this all mean? Well, as you can see right there, the inflation actually went to asset prices. And who typically owns assets? Well, that tends to be people on the wealthier side of the equation. And what else supports this evidence? Well, at least here in the US, the wealth gap continues to widen further and further, and that has really accelerated over the past 10 years. Alright, that is a separate problem in its own video, but it supports the data that shows inflation not happening at an alarming rate at all. Now, yes, it goes up and it goes down, but never near hyperinflation levels, and instead we see the inflation going into assets. Now yes, again, we will see some inflation in prices, but the Fed wants that, and if it gets too hot, they can simply raise rates a bit to control the prices. Which, as we saw a few weeks ago, just the fear of a rate raise hurt the stock market big, but didn't really affect prices anywhere else, which again points towards asset inflation, not consumer inflation. And there are actually a bunch of other factors as well as to why I don't believe we will see hyperinflation, such as the dollar being the world's reserve currency, and the whole world printing money at the same time thing, and the petrodollar, and actually a host of other reasons, which a finance nerd like me can geek out on for hours, but I won't do that to you guys today. So what can you do about all this? Well, since all this is completely out of our control in the end, all you need to do is simply stick with the plan we always discuss. Doing the basics like taking care of your money, living below your means, don't take on bad debt, create infinite money loops, and invest that money in great assets like real estate and great stocks, which also kind of feed that loop to reinvest again. And if you're not sure on how to do any of those things, my next 2 courses coming to the private group cover things like money management and creating infinite money loops to combine with the stock course that's already in there so you can have all the information to maximize your investing. So don't forget to sign up for the private group if you're looking for the ultimate set of tools to become a better investor. And remember, you can try it and cancel it if it's not right for you. So thanks for watching, and we will see you in the next one. Thank you.